Welcome back, everyone. Here is a big question for you today. Why did the Federal Reserve delay its interest rate cut? And the answer involves three surprising factors.
I'm curious. When I first heard about this delay, I wondered, why would they wait even longer? What changed? To understand this, let's look at where the Fed stood a year ago and what was happening in the Middle East at the same time.
Right, because those two things, a major bank's decision and a war far away, ended up being very closely connected. And most people don't see that link.
But first, let's quickly define three key words.
The Federal Reserve, or the Fed. Think of it as the boss of all banks in America, deciding how expensive or cheap it is to borrow money.
Interest rate, the cost of borrowing money. High rate means expensive loans. Low rate means cheaper loans, so people and businesses can spend more.
Third, inflation. Prices going up. When inflation is high, your money buys less. Last year, a coffee was $2. This year, it is $3. That is inflation.
Now we have our three words. Let's tell the story.
So here is what happened. Going into 2024, the Fed had a clear plan. Inflation had been very high after the pandemic, but by late 2024, it was finally starting to come down. So the Fed said, okay, we will start cutting interest rates in 2025. Lower rates, more growth, better economy.
Cheaper loans, more spending, more jobs. That was the plan.
Exactly. But then things changed. The conflict in the Middle East got much worse, and that created a big problem for the global economy.
The Middle East is critical for oil production and global shipping. When there is conflict there, oil prices rise and shipping becomes more expensive.
Right, and when oil is more expensive, almost everything else becomes more expensive too. Transport, manufacturing, food, all of it goes up in price.
So inflation, which was going down, suddenly had a reason to go back up again. And that put the Fed in a very difficult position.
Because if the Fed cuts interest rates while inflation is rising, that makes inflation even worse. More money in the economy, plus rising prices, that is a very bad combination.
That makes total sense. So the Fed looked at the war risk, looked at the inflation numbers, and said, we cannot cut rates yet. Let's wait.
Not just a little wait, they pushed the cut all the way to late 2026. That surprised economists, investors, and everyday people hoping for cheaper loans. The three factors: 1, war driving up oil prices; 2, higher shipping costs; 3, global uncertainty making investors nervous.
None of those three things were in the original plan. That is what made this delay so surprising.
Okay, so now let's talk about the three big lessons we can take from all of this.
Lesson 1. Global events affect your everyday life. A war in the Middle East can raise your grocery bill anywhere in the world. Everything is connected. Never think something far away does not matter to you.
Lesson 2. The Fed must be careful with timing. Cutting rates too early, when prices are still rising, can make inflation explode. Waiting is sometimes the smarter choice.
Lesson 3. Delays are not always bad news. High interest rates mean expensive loans now, but they help control prices. A little patience now can mean a much more stable economy later. So to wrap up, the Fed delayed its rate cut to late 2026 because war-related risks pushed inflation higher than expected, and that changed everything.
It really did. And now you know the full picture, not just what happened, but why it happened, and what it means for all of us.
Which part surprised you most? Comment below. We read every one. And share this with someone who wants to understand the world economy.
See you next time.